I believe we're going to get a one-to-one with regard to gold and the Dow at one point. So let's say the bottom of the Dow is 6,000. Let's just say, okay. I think we can get gold 6,000. I think the gold to silver ratio is going to be 15 to 1, 10 to 1. Do the math. It's not hard. Commodities across the board are going to skyrocket in this kind of an environment. Cash is going to make its way into other things too. Not just most undervalued, of course, but it's going to go in a lot of different places.
Gregory Mannarino, the founder of TradersCoin.net and a prominent financial strategist, proposes an intriguing correlation between the Dow Jones and gold prices, suggesting a potential 1-to-1 ratio if the Dow Jones hits a specific low level, such as 6,000. Pointing to historical instances, both the stock and gold markets experienced a simultaneous plunge in March 2020, followed by a joint rebound in April. Despite Fed Chair Powell attempting to downplay expectations of interest rate cuts in the spring, the Dow Jones reached a new all-time high of 36,265 in December 2023, coinciding with gold's ascent to a record high of $2,089 per ounce, illustrating the interconnectedness of these markets. Mannarino anticipates a shift in the gold-to-silver ratio, projecting a potential range of 15 to 1 or even 10 to 1. He underscores this change's transformative impact on silver, emphasizing the metal's potential for explosive growth within an altered gold-to-silver ratio. Currently standing at 88.70, the gold-to-silver price ratio signifies that it takes 87 ounces of silver to purchase 1 ounce of gold. As the Federal Reserve cuts interest rates to combat inflation, the gold-to-silver ratio widens, indicating a historical pattern that may precede a substantial rally in silver prices. Mannarino's predictions extend to the broader economic landscape, foreseeing global shockwaves triggered by a potential uncontrolled sell-off in the debt market. Such an event could lead to resource shortages and a surge in commodity prices on a worldwide scale. Contrarily, analysts at Scotiabank, while maintaining a cautious stance, adjusted their price guidance upward. In a recent note, they disclosed their adoption of higher price projections for gold and silver in the current and upcoming years. Notably, they revised their year-end gold forecast from $1,900 per ounce to $2,000 per ounce, reflecting a nuanced perspective amid evolving market dynamics. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I like silver number one, gold number two, platinum, palladium a third. I don't rate them 3 and 4. I think they're equal right now as opposed to their value. Now, how do you gauge what their value is? It's a really good question, and I tell people it's a very simple equation as well. I try to break this down really easily. Okay, you look at where the Dow Jones Industrial Average will eventually go. Who knows where the bottom is? We do know that the Fed jumped in here at Dow 6,000 with QE1. The bottom of this market could still be somewhere 6,000, 8,000. It's nowhere near where it is now. This is just market that's in la land on easy money policies and monetizing the debt. Okay, so I believe we're going to get a one-to-one with regard to gold and the Dow at one point. So let's say the bottom of the Dow is 6,000. Let's just say, okay. I think we can get gold 6,000. I think the gold to silver ratio is going to be 15 to 1, 10 to 1. Do the math. It's not hard. Commodities across the board are going to skyrocket in this kind of an environment. So that's how it's going to play out, in my opinion. And again, and I think, again, cash is going to make its way into other things too. Not just most undervalued, of course, but it's going to go in a lot of different places.
Why is silver above gold? Because of its explosive
Because of the
nature?
silver to gold ratio, number one. And I think that is going to vastly change. I think a 15 to 1 is realistic. A 10 to 1 in an extreme situation, if we get, let's say, an uncontrolled sell-off in the debt market, which I believe is going to happen at one point here, and that's going to put so much pressure on world stock markets, it's just going to wipe them out. It'll be a global phenomenon that is going to send the world shockwaves around the world, unfortunately. And then we're going to end up with another situation too. I mean, what this is eventually going to boil down to is a resource issue. And skyrocketing prices for commodities and stuff across the board. It's pretty much a no-brainer here. And you know what central banks are doing here is really they're the enemy. They've been creating inflation here, and they've gone out of their way to do it. Now we're expecting them to fix it. I mean, come on now. Look, the current system is dying. We are in a full-blown liquidity crisis right now. People aren't being told that. and central banks have to make up the difference by again inflating here. We're watching the purchasing power of currencies, and central banks have been killing their currencies now. I mean, since like almost forever, literally sucking the purchasing power out little by little, almost like the boiling frog syndrome. But this system is dying in its current form, and they want to simplify the system. The central banks of the world are looking for a system which they can use cross border, almost like a single one world currency. Without having to worry about transfer rates or anything like that. And I've already outlined for people what it's going to be, and it's very clear. We're going to have a completely tokenized system. Every asset, in fact, it even goes beyond that, is going to become tradable via a token. People are going to have to face up to that because that's where we're going, and there's literally no way to stop it. The central banks have been working towards this since their inception. I mean, central banking, this whole thing, they are so methodical, they are so exacting, they know exactly what to do because it's all been thought out before. We're living in the side effect of what central banks have planned out almost a century ago, and it's going to go on and on and on
So
as
let
they
me
lead the people down this pathway here. They're creating dependency on the current system, slavery to the current system. This kind of sound like the Great Taking because that's exactly what this guy was talking about here on their system until they issue in this completely new system. And the problem is, and but by them making people dependent on the system now, it's going to be easier for them to implement, but they got to destroy the current system, and we're seeing it come apart right now in the economy of the world, which is cratering at its fastest pace we've ever seen. And it's just not going to stop until they're done, and they're not done. We're going to see this go on and on and on, at least until the election, and then we'll have to readdress this because they want to get through that first by keeping the markets inflated.
In a recent analysis, Mannarino raises skepticism regarding central banks' capacity to manage inflation, drawing attention to a cautionary note from BlackRock that highlights potential miscalculations in inflation forecasts. He asserts that central banks, notably the Federal Reserve, may intentionally fuel inflation and are unlikely to deviate from this course. According to the BlackRock Investment Institute's recent note, the persistence of inflation pressures is attributed to fragmentation, with policy rates maintained above pre-COVID levels. The Institute anticipates inflation remaining closer to 3% in this new economic regime, aligning with a growing chorus of financial market participants expressing concerns about enduring price gains. Mannarino emphasizes the importance of grasping the underlying mechanisms at play, particularly the creation of cash out of nothing by central banks. This practice, coupled with expanding the central bank's balance sheet through substantial securities purchases between 2008 and 2022, stands out as one of the most controversial actions the Federal Reserve has taken since the 2008 financial crisis. As the debate over inflation dynamics intensifies, Mannarino urges individuals to delve into the intricacies of these financial maneuvers to better comprehend their implications on the broader economic landscape. Let's get back to the interview.
There's zero connection between the markets and the economy. No, this exact hand motion is something I've shown people for 10 years. This gap is going to continue to get wider and wider here. Eventually it's going to get real, but this gap between the market and the economy is going to continue to go off the charts. It's just going to keep going and going. There's no connection. What we're seeing here too, it's kind of interesting. You got these corporations here that are laying off people by the thousands. Something I said was going to last year. We're going to see this accelerate much further. What are they doing here? They're trying to get lean so they can, increase their bottom line by laying off people. Seriously, this is going to get progressively worse by people who have no idea where we're going against. It's a deliberate destruction. The market fundamentals don't matter anymore. Things like forward guidance, PE ratios, balance sheets, all this, that doesn't matter. The market doesn't even price off of that anymore. It's been replaced by a system of easy money, monetizing the debt, and we're going to see a lot more of that moving forward. Now, a bigger player in this is war, an expanding war. This is going to be very, very positive for the stock market. Again, where does this cash come from? Do we have a war chest? Did any developed nation have a war chest? No. The Federal Reserve in this case has to make the cash created out of nothing, and so we can fund all this stuff. And the more cash they create out of nothing, the higher the market's going to go as the purchasing power of the dollar gets erased. This whole issue with inflation, it's been the biggest farce in the history of the world. Oh, the Fed's in the fight of their lives. It's a joke. They've gone out of their way to create inflation. They're not going to stop doing it. As a matter of fact, we just got a warning from BlackRock today that, oh, imagine my shock, that inflation forecasts are going to be way, way, way off, according to BlackRock. In other words, we're going to see a lot more inflation coming. I mean, I'm telling, it's not going to stop. That's the mechanism here. And people just need to understand what's happening, and then they can get themselves on the right side of this. I've been telling people this for the longest time. The illusion of the market will be maintained. People still believe that there is a connection between the economy and the market, which does not exist in any way, shape, or form. So generally, people walk in the streets who don't understand this. They see the stock market. Oh wow, the S&P 500 just hit a new record high. The Dow, new record
Right.
high.
Right.
Oh, this is fantastic. Our economy, we're booming. But then people look upon themselves and say, well, why can't I make ends meet? How come I got to keep borrowing from my credit cards? Why am I tapped out? My savings are gone. This is what's happening
Right.
here. It's a crazy situation, but people don't know. They don't spend the time to understand it. They don't want to understand it. They believe that it's just gonna. The system works because people believe it's gonna work. Meanwhile, that's how they're taken advantage of by the Wall Street institutions, by the central banks around the world. Now, the great taking. I watched the documentary. Not a single person that follows my work should be surprised. That everything that was in there, I've been telling people way before that documentary came out. I mean, I watched it. I'm like, I wasn't even going to. I'm going to be honest with you because I understood it in my own head. I said the guy probably sees the same thing that all of us do that understand how the markets work and how cash moves through the system.
UBS strategists express optimism about the potential for gold prices to finish the year up to 10% higher than current levels, driven by the prospect of interest rate cuts. Despite facing declines early in 2024, gold maintains its position above the psychological threshold of $2,000 per ounce. How might the prospect of interest rate cuts impact the broader landscape of precious metal markets in the coming months? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.